I'm just going to start by acknowledging that I'm chairing this webinar from the lands of the Darug and the Guringai people, who are the traditional custodians of the land that I work and live on, and I pay respects to their elders past, present and future. RACS acknowledges that the Aboriginal and Torres Strait Islander people are the traditional owners of the land that we are all on today, and extend our respect to elders past, present and emerging. As a binational college, RACS acknowledges and respects the Naiua Maori as the tangata of Whenua of Aotearoa, and is committed to upholding the principles of Te Tirati o Waitangi, fostering the college's relationship with Maori, supporting Maori fellows and trainees, and striving to improve the health of all Maori people. Forgive me for butchering that Maori. I was obviously very tired and I've only had one cup of coffee today, so that was terrible. Thank you and welcome everybody to our latest edition of our Women in Surgery leadership webinar. Today, we're really happy to have two fantastic speakers. These webinar sessions are being sponsored by Frais Capital, and Siobhan is the person who is the founder and CEO of this, and we're really grateful to have Siobhan not only sponsor us, but for all the things that she does to the college. Basically, she's had 30 years of experience, including being a partner at EL&C Baillieu, the executive director at Morgan Stanley, and now obviously as the founder and the CEO of Frais Capital. She's also the chair of the investment committee at the College of Surgeons. And so she's been basically helping the college with all their financial profitability. She is an honorary advisor to the college. She's a member of FCJ and Cottage by the Sea Investment Committee. She's a mentor to rising stars and women in banking and finance. And she's also a director of the Sid and Fiona Meyer Family Foundation. Siobhan, I don't know if you know, but my sister actually works there. So she's got deep market and macroeconomic knowledge, and Siobhan provides holistic and tailored investment advice, seeking to understand a client's full financial position, providing advice specific to their needs, while also presenting unique insight and access to the highest quality macro and stock-specific research, translating to actionable investment opportunities. And I know that there's several female surgeons who invest with Siobhan, and so I'm really pleased to have Siobhan give our first talk. And after Siobhan finishes, I'll introduce Anna, who's giving our second talk. Siobhan, I'll hand over to you.
Excellent. Well, thank you, Pinky, and thank you, everyone, for joining this evening. Well, the key headline at the moment is the gold price and the crypto price. That seems to be the headline. I'm going to share with you, though, a few more things that we need to think about. And here we go. All right. And for fun, I might just share with you my trading screen so you can see what today looks like. Here we are. We have a day of green. So this is the stock market in Australia today, for example. This shows us the performance of the stocks. Green is good, is the message. Red is bad. Now, ANZ, for example, up 1.9%. CSL, that we focus on a lot, they're up significantly. Macquarie had a good day, up 5% today, and they're talking about selling their data centres. So our job is to sort through the noise. Sort through the noise and, I suppose, provide a clear investment path for you. Now, I'm going to stop sharing that screen and let's get on to the presentation. The key for us, and I'll make sure that these slides are available so that you can consider this later, but the 4 points that I want to highlight this evening are really around wealth creation, risk and return, superannuation, steps to financial security, and then choosing your team. Who do you have on board? Now, there's lots of conversation about the huge money that's being made in crypto and gold at the moment, but I wanted to remind us all of the different asset classes that we can have. Now, you will all be well and truly familiar with this, but the conversation really goes like this: cash, fixed income, shares, they might be local shares, they might be international shares, property, and alternative investments. And the alternative investments are getting a lot of attention at the moment. But the message is that when you're investing, you want to make sure that you've got high quality ballast in your portfolio to make sure that when the crypto falls or the gold price falls or the tech stock declines, that you've got the ability to pay the staff, pay the rent, and so on. So the message is that we've all had exposure to this through our super funds, but I just want to show you here this graph which highlights the power of earnings. And the message ultimately is that if we've invested $100,000 10 years ago, October 2015, and we've got it in a fixed income investment in an Australian bond, for example, we've got about 2% return per annum. So our 100,000 is now 122,000. But if we go to Australian shares, where we're getting about 10% return a year, our return is $164,000 over our 100,000. So the power of compounding here is significant. So we put 100,000 in, and 10 years later, it's worth 260,000. And then if we dial up the risk even further, we look at the power of the US earnings, the US market, for example, the returns there at 13% per annum, which doesn't sound like a significant step change, but all of a sudden I've now got $240,000 more than I started with 10 years ago. So the message in all of this is the power of compounding and what 1, 2, 3, 10 and 13% return does over a 10-year period. This is material. What I want to pose here is to think about your risk profile. As investors, I get people coming to me daily to say, I'm interested in the market, I want to buy something, I want a piece of the action. Now, the important point to reflect on is what is your risk profile? And you know in the stock market and investing there's a particular language, risk profile. The message is that when you're starting and you've got lots of earnings capacity or a long time to gather wealth, you're going to be able to be more aggressive in your risk profile. Now, as you progress, the message is that you want to be more conservative, and as you generate capital, you want to protect what you've earned. The message ultimately is, and the point that I make here, check your super balances and check what risk profile you are invested in. Make sure that it's fit for purpose. For example, if it's conservative, that means fixed income, cash, bonds, and a return of about 4.5% given today's interest rate. Balanced, that means 50% of your portfolio is sitting in those.
Oh, it does. Yeah. Well, he's one of the.
And the challenge is ultimately that from here, you make sure that you're in the right buckets of money. So my one message here for you is do check your superannuation risk profile. You might say that I'm in balanced or high growth. High growth usually means about 70% of your assets in growth investments, equities, if you will. And you remember looking at that graph prior, in equities, particularly in the US, this earnings potential is significant. If it's sitting in cash, it's not going to grow as much, or in fixed income. But by the same token, you don't get those significant drawdowns like we saw in April. So the message is, when an advisor says to you, what's your risk profile, know what it is, challenge them to say, well, you tell me what you think it is. And the message is, make sure your superannuation fund is in the right risk profile. What we do see is that investors, say, for example, in April this year, were spooked by the market collapse from tariffs, which is particularly understandable. But if you've moved your risk profile to conservative, that means you're selling your share portfolio at a low and possibly missing the recovery on the upside. So I highlight how important it is to have the right risk profile with your age and stage, but also understand the implications of the change. So the message is, when we're wanting to build our wealth, we are in more growth-focused assets, which is shares and alternative assets. And the message ultimately is to think about, where are we today? The lay of the land at the moment. Now, this graph is highlighting the huge investment that is in AI. And the capital investment in large tech from Amazon, Google, Meta is stratospheric. We're talking billions and billions of dollars. And the conversation ultimately becomes that this capital investment in the US has helped the US to avoid recession. All of these companies ploughing capital into the business, into the economy. Interest rates are at, let's say, reasonable levels. They're not too high, but the US market is expecting interest rates to cut from here. So the two key themes that are right in front of us from an investment perspective today are data centres, AI, interest rates. Is it a bubble? And the message is that the capital investment in this area is significant. So I want to just ground you in understanding where are we today with the stock market, because that's where we can add insight for you. Now, the US stock market versus the Australian stock market. If you remember from that graph on slide 5, the Aussie market generating 10% a year is good, but the US market is doing 13% plus. Now we've had years of 20+%, and you can see the power of compounding. The point of this slide is to show you the earnings projection. The first graph shows the ASX 200, so that's the Aussie stock market, and the S&P, which is in the orange line. And the blue line is the Australian market earnings, the profitability expected over the next 12 months. What we're seeing is this strange situation where our earnings are expected to go down. And that is the mining stocks, earnings less than expected, the industrial stocks feeling the pinch from cost increases. And broadly in Australia, we're saying, look, we're profitable, but the profit margins are a bit less. Whereas the green line is the US, and that shows the earnings momentum is significant. And this is thanks to one thing, it's AI. The tech margins are significant. The earnings margins are over 30%. In Australia, we get excited when it's 6%. So the message is that make sure your portfolio has exposure to the engine, which is the US stock market. Now, it will add a whole lot of volatility, so we need to understand and be aware of that. But the power of the US market with its earnings that have grown exponentially from 2020 to 2025, there's a huge power of growth. Now, there's a few ways to gain exposure, and we can do that to the Australian stock market, where companies have big earnings in the US, or buying directly into the US. The conversation then becomes, is it expensive? Is now the right time? Does it feel like a bubble? Am I buying at the top? And the problem, and I suppose the challenge, is to say, how do we measure value? Now, in Australia, we look at the price to earnings ratio, and that's really the price divided by the earnings. And that gives you a sense of value. Now, this slide here, or this graph, shows the PE and the change over time. Price over earnings in Australia, the average since 1987 is a PE of about 15 times. Where we are today is a PE of 19. So the message is that in Australia, we're expensive. It's hard to find value. Now, part of that is because we've seen a huge amount of capital inflow to Australia as safe haven from the US, and international pension funds like the Canadian pension funds are putting money in Australia. So this is why you're partly seeing Commonwealth Bank at $160 a share, or Wesfarmers over $90 a share. We're expensive. And the challenge is to know what you're buying. Now, I'll take you to the next slide, which shows us the dividend yield. And Anna and I were talking prior to our presentation about cash flow. We want cash flow. As business owners and as investors, we want growth, but we also want companies that are going to pay us cash to do, what you need to with. This graph on the right, the blue line, shows us what the dividend yield in Australia is. So that is your earnings from company profits that are paid out on a semi-annual basis to you as an investor. Now, we used to have a few years where the average dividend was about 4.5%, plus franking gives us about 6% return just from income. That doesn't account for capital growth. And what we've seen is that as prices go up, the dividend yield is going down. So we're seeing an average yield of about 3% on companies at the moment. That's historically low. Part of the reason around that is that the price is being pushed up. And what we need to understand is companies that can pay decent dividends. Now, we've got a range of companies that can pay 6% return, but we've got those sorts of companies that are new and growing that don't pay any cash flow. And Anna and I were debating crypto, and we were saying the idea around crypto, well, that's a whole interesting asset class in itself, but there's no income from it. The Australian stock market is favoured because it has this high dividend paying characteristic, which is unique in the world. And the franking credits, that's also unique, and that adds another couple of percent to the return. So the message in Australia is that we can park our money in high quality Australian names and generate about 5% return. That's okay, but it also doesn't take into account the capital growth that we expect. So good Aussie stocks should be able to pay at least another 5% from capital gain. Now, I'll pause here because the fun at the moment is what is happening to the gold price. And this was taken a week ago of the line outside the Australian Bullion Company in Martin Place, Sydney. The gold price is at record highs of $4,200 an ounce. And people are now buying it. Well, our conversation is it time to sell? I think ultimately gold is like the ballast for you. It doesn't pay you an income, but it's a store of value. And this graph highlights to us the performance of gold over the last number of years, since 2018, for example, where it was about $1,000 an ounce. As you know, it's now $4,200 an ounce. And investors have continued to buy, as have governments. We can see the Chinese government is significantly buying gold. They want a store of value that is beyond US treasuries. And there is a concern about the shift in the US political environment, which means, do we hold all our assets in US dollar investments? People and countries are buying gold because they remain nervous. And so the message is, you will probably continue to hold gold. Now, my comments here are generally natural, and I would encourage you, it's important to go and seek your own advice. But the message ultimately is, when it is unstable, people hold gold. It doesn't pay you anything. There's no income. You've got to pay to store it. But we can see the huge interest and inflows into the blue line, showing exchange-traded funds that track the gold index. Huge inflows. And the gold price continues to go up with every shock. So the message is, do you have gold? Do you have a chain, a link? What does that look like? And there's really easy ways to gain access to the gold market through a range of different Australian-listed exchange-traded funds. Now, I'll pause and make another point, which is along the lines of, when you're choosing companies to invest in, there's an interesting observation which goes along the lines of this. Show me the incentive and we'll look at the outcome. When you're considering what company to buy, we look at things like the CEO pay. Now, we're not looking at this to be cute or smart about it, but what we want to understand are those companies that have CEOs with low fixed pay and a really high incentive. So variable pay high, fixed pay low. And the reason for that is we can see that the businesses that have that structure, like Macquarie Bank, incentivise their team to do the best they possibly can. What we can see is that when there is low fixed pay we can see returns of over 15% per annum versus when there's high fixed pay. Okay, but I work for a bank, I run the bank, and the performance there is okay. The average pay is about 2-3 million a year, whereas the CEO of Macquarie, for example, has a low fixed salary and very high incentive. So the message is that the leaders of companies that you own need to be incentivized correctly to work for you. And what we can see is that those that have got a lot of incentive work harder, share prices perform better. Now, the next point of what I'd like to draw to your attention is around wealth creation. And the conversation goes a bit like this. Now, you will all be able to answer these questions, but the questions that we know, for example, basic questions that are asked of millennials, about 50% of them are unable to get this correct, i.e., what is the percentage of your salary that goes into super? What age can you access the super? Can you make personal contributions, and what's the tax rate? Now, all of these things will be well familiar with, but it's interesting to see that in Australia, a Vanguard survey shows that half of the Australian, the millennial population are unable to answer this correctly. And more shockingly, we see that half the Australian population is not financially literate. So the message that we have here is check what your superannuation contributions are, make sure they're the right number. And the question also is, can I access super? Know when you can do that. Make sure you've got a good accountant to check what the super contributions should be. And the tax rate, what is it? Now, what's interesting for Australia is that we are, by population of the OECD countries, about 50-50. We're small. But we have the fourth largest pool of money in the world. And that is a consequence of superannuation. It has a huge engine of capacity to invest in a range of things, whether it be Australian shares, infrastructure, critical minerals, a range of things. And the broad message is that you have a part to play and you have choice about how your superannuation money is invested. And the large industry super funds are now much more attuned to this. So my key message here is check your superannuation. If you're an industry super fund, check what the risk profile is and see whether you have some choices around what you want to invest in and things you want to exploit. Know that, the impact on your earnings, and ultimately remember the power of compounding. So we'll take to the slide here about compounding. The message is that we see here in superannuation average contributions over time on the basis of your contributions. 6% return at the age of 64, we're looking at 2 million. 10% return, we're aiming for 4.4 million if we start at 30 and contribute. It's very powerful. Now, my three key messages within superannuation is check that you have consolidated your accounts. There's about 4 million in Australia, 4 million people in Australia with multiple superannuation accounts. That's just a waste of fees. It's a waste of your money. Make sure that it is consolidated to one fund. You might have your own superannuation, self-managed super, or it might be in an industry fund, but do check that at the time and make sure that your employer contributions are what they say they are. Now, most of you will be working for yourselves or for hospital, but do check this or have your accountant look at it. Make sure that it's up to scratch, because we say that about nearly 6 billion a year is not properly allocated to people, with employers not paying the right number. And check what the voluntary contributions are, because if you've got a little bit of spare cash, remember the power of compounding, that it allows you to significantly grow your wealth over time. And ultimately what we see, buying good quality assets, whether that, and make sure they're growth assets, it's the power of compounding over time that will be the most important for you. Now, Self-managed super. It'll be relevant for some people, it won't be for others, but I raise it because it gives you flexibility. It allows you to think about perhaps having a practice property in the super fund. It allows you to manage cash flow. It allows you to look after there's estate planning considerations. And the message is that it may be relevant for you. Now, some of you will have self-managed super funds with assets in them, and others will be saying, I don't want to think about it, it's too hard at the moment. But I raise it as a vehicle because it gives you choice. And that's the key here, the autonomy, the choice to invest how you want. And ultimately, there's no one like yourself to look after your money. I raise this as a consideration. Now, in terms of financial security, this brings me to the last part of my presentation. And ultimately, the key here is to have the right team. Now, you know this but more than many about how important it is to have a really strong team around you. Decent accountant, lawyer, financial advisor. You'll have their phone numbers on speed dial. But the message is, make sure that you have this information available for family members or other people in your world in case you are unavailable. I find now that people, in my experience, have been, and we've all got different experiences, but it's important to have these sorts of contacts in place that you can sense check along the way. I had a funny conversation today with a client who rang and said, Siobhan, I've won a car. I've won an Audi, a Q6. This is ridiculous. It's way too big for me. I don't want it, but wow, what do I do? And so we went through a range of things and it was captured. But the message is, if you've got these ongoing relationships, it just helps to manage and to limit the effort and the energy that you need to think about that. Now, have a look at your insurances, for example. Some of you will have insurance. Most of you will, from a practice perspective, have a look at your own individual insurances and have a broker or a financial advisor check that you're getting value for money. Are you getting what you're paying for, or does your superannuation fund already provide some insurances for you? So my main message is have a look at it, insure your debt, and make sure that you are reviewing on an annual basis your insurances. Talk to others around you to check that you're getting value for money. Now, the third point here, and bringing me to the final part of my presentation, is that asset management. You want to make sure that there's tax efficiency in what you're doing. You are busy, you're running from one thing to the next. But take a moment to have that annual conversation with the accountant about whether the structures are fit for purpose and that the tax that you're paying is appropriate, or could it be less. The asset management and the maintenance of your hard-earned money is an important conversation to have. And no doubt you'll be having it, but my prompt would be to say, check that the structures are right, check that the assets are in the appropriate structures and that you're not paying any more tax than you need to. Then the other point in all of this is your succession planning and estate planning. People come to me and say, Siobhan, all right, I need to make sure that this is going to look after my children when I'm not here, or if I'm unavailable, what happens to the money? You might be in a situation where you're the key breadwinner and other parties aren't financially literate. So it's important that the structures are in place that are enduring and that can handle it if you're not in charge. And so my advice would be check with your. Have you got that will in place? Have you got the power of attorney in place? Is it current? And the third point, binding debt nomination. For the superannuation account, make sure it is current. And the reason for that is that your wishes are adhered to. And from a tax effective perspective, who gets what when, it is important. And so this brings me to my final slide. And what I would say is choosing your financial advisor. Now, there's a whole lot of heat in the market at the moment about bad advice and fraudulent investments. and people's hard-earned money is being lost. There's a couple of things that we can do to sense check, and one of the key things is checking whether your financial advisor has an Australian Financial Services licence and are they registered on the Financial Advisor Register. That's the first. The second point is that you'll probably need to interview a range of different providers. Bring along a trusted source, include your accountant in the conversation, and make sure you're getting all the source data, the contract notes, the CHESS statements, the audit. It is important, and this is where the accountant provides a huge amount of oversight for you. Set a diary entry to make sure that you're doing this, because it's taking that initial step to say, where is my money? How was it invested? And when I want it, is it available? That's the key. The beauty of the stock market is that it provides the liquidity, and within 2 working days' time, cash is in your bank account. Right now, it's important to make sure that you've got the right advice around you, the appropriate team, and then it's about getting on with it. So I'm going to stop there, and we're going to hear from Anna now, who's going to have a further conversation. But thank you for the opportunity to share a little bit about the stock market. Thank you.
Thanks. Thanks so much, Siobhan. I've got a few questions that are ruminating in my head, but we'll have a discussion after Anna finishes speaking. I just, every day that I get closer to retirement age, I keep wondering whether I've got enough to retire on or whether I'm going to have to be buying cat food to feed myself. So our next speaker is Anna Pham, and Anna was actually my resident when I was a surgical registrar, but she has overtaken me with all the wonderful things that she has done. She is somebody who truly embodies what it means to build both purpose and prosperity. She's a medical doctor, she's an investor, and she's an entrepreneur. She began her career, like many of us, fully immersed in medicine. She's a single mum with 2 young children, and she wanted to create more stability and freedom for her family. And what first started off as just one small property purchase grew into a $25 million investment portfolio and multiple medical practice partnerships. She is passionate about helping women in medicine reimagine what's possible. And she shows us that we can continue to serve in careers that we love while also designing lives that give us choice, freedom, and financial security. And Anna's been fantastic. She's spoken at a previous surgeons thing, and now she's going to come and speak to us as well. So thank you, Anna, and I'll hand over to you.
Thank you so much for having me. Just a microphone check. I'm talking through my computer. Is there an echo, or can you hear me quite clearly?
I can hear you really clearly.
Okay. To start with, I was hoping to share the responses that the doctors wrote in their questionnaire, if that's okay. I'm not very good with the computer, so let's see how we go. Okay. So some of you may recall receiving an email asking 5 basic questions, and that was to help Siobhan and I suppose, understand where your headspace is at and where you're at in your financial journey so that we could tailor this presentation to suit your needs. Let me just close that. Now, the first question was, which best describes your current professional and financial situation? And 37% of you said, I'm a consultant looking to diversify income. That was then followed by 1/4 of you, 25%, who said, I'm interested in developing business or investment ventures. So there was a lot of investment interest across the board. The second question was, what is your main goal right now? And 43% of you said, I would like to know how to invest for long-term financial freedom. This is then followed at 18.8% by, I'd like to learn business and money skills, and I'd like to increase income or build wealth. Third question was, what's your biggest challenge when it comes to money, business, or investing? And 50% of you said, I don't have enough time or business knowledge. And then the other 22% said, I'm actually not sure where to start. Thank you for the honesty. Question 4 was, well, what level of capital or budget could you comfortably allocate right now towards either business growth or towards your investment? And 1/3 of you said, I've got between 5 to 20,000, so I'm ready to begin with structured support. And the rest of you, it was equally divided between, I've got 20 to 50,000, so I'm looking to grow with strategy and guidance, or I've got 50 to 100,000, so I'm prepared to make a serious investment into the next venture. And then an equal amount had over $100,000, and it means I'm ready to scale or launch at a significant level. And then lastly, there are some of us who are at the beginning stages of our financial journey. So I've got under 5,000, I'm just getting started. And the last question was, is there anything else you'd like me to know about your current business, financial goals, or mindset growth? And I can bring that down. There was a bit of diversity in the answers, ranging from I'm a consultant with a house and mortgage, and all of my money's in offset, and I'm paying lots of tax for work as a contractor. So I'd like to know how to make this money work for me. I think one of my slides may help you there. Others would say, I don't know where to start. I feel like I get advice from accountants that I follow blindly, but I don't really understand what I'm doing. And I think that's the majority of us. Others says, I'm in high income but low time household. So I really want to learn about money management and how to create wealth, but make this as easy as possible, please. I'm in a 2-surgeon income household. Someone else said, I'm looking for a strategy for a firm financial plan that will secure me in retirement, either with investments or through increasing my private practice business income. Majority of you said, no, there's nothing else I need you to know about me. And then others said, ways to manage income and assets efficiently, and how do you factor in maternity leave and the household income drops. Do you get the gist? So what I got from this is that tonight we've got a wide range of people in the room at different stages in your financial journey. And I'm hoping that through sharing mine, I'll be able to maybe offer a little bit of insights for each and every one of you who may be able to where I can share a little bit of my journey, and you may be able to reflect and see where you are at and where you correspond with my own journey at any given time. I'm just going to stop sharing so I can go on to my presentation. All right. Am I actually doing the right thing and sharing my presentation, Becky?
Yes.
Oh, you can see that IT is not my strength.
I can see it. You might want to just put it into slide view. Slideshow. Up the top.
At the top, slideshow.
So home, insert, yep, there you go. And I think if you do it from beginning, yep, there you go. Well done.
Yep. Okay. They say that you outsource your weakness. My IT costs are really high in my business to make up for everything beyond turning on and off, Anna. So my apologies if I I encounter cumbersome points from this point onwards. But as Pecky says, thank you for the introduction. I am a GP. I work in Southwest Sydney. I am a practice owner and I am an investor. And it is my hope from this point on to be able to empower doctors to achieve financial confidence and independence. Why do I do what I do? Why do I stick my neck out and talk to you about money? Because some of you who follow me on social media will see that I share my story very openly and very honestly. And in doing this, I risk personal scrutiny, I risk ridicule, I risk being considered vain or looking like I'm looking for validation from my peers. All these things have gone through my mind. I am hoping that by sharing my story and having you share yours with me, that this connects us more deeply to our purpose and for us to trust each other. And what I share with you tonight, I share and trust that you will treat my story with respect. I talk a lot about money, but my core message is not about money. It's about agency. I want you to know that you can be both an exceptional surgeon and a confident investor. Money doesn't take away from who we are as carers, but it does give us the power to keep on caring on our own terms. So who am I to be here talking to you? I was born in Vietnam. At the age of 7, I was put on a boat and we fortunately landed in Malaysia, where I spent 6 months in a refugee camp. By age 8, I arrived in Australia with no English, and my favourite dresses, even to this day, were those that I bought from shopping sprees at Vinnie's. Between the age of 8 to 18, I attended the local primary and secondary public schools. No, they were not selective because my parents didn't know what they were. By age 19, after 2 attempts in year 12, I finally made it into medicine and I attended the University of New South Wales. And 6 years later, I completed my degree and got the MBBS. By age 28, I got married. By age 36, I was divorced. So up to this point, I was the proverbial good child. I was very good at following my parents' well-intentioned prescription for me in my life, and I didn't know any better and I was happy to comply. No one enters a marriage with the intent to divorce, and certainly that wasn't my intention. So this was definitely a curveball in my life. I entered a state of flux, but then my new chapter began. My focus shifted to caring for my own future and that of my 2 children. At the time, they were 2 and 4. I became laser focused on creating financial security. I wanted my kids to have stability. And by that, I meant to be in the same home and in the same school. I've now found myself on a single income. So what did I do? I lived simply for years. I cut out all luxuries and I saved every spare dollar. I had a goal. My goal was to pay off my home and build a safety net strong enough to protect my family. This cash that was sitting in our offset became our emergency fund. Once I had this safety net, I began aggressively investing in property, starting with residential. In just 4 years, I purchased 4 homes across New South Wales, Western Australia, and Queensland. They were all tenanted and looked really good on paper, but the results were very underwhelming for me. Rents rose only modestly and the capital growth couldn't be realised. That is, I couldn't do anything with the growth in the value of the houses unless I sold them. And then in 2021, COVID hit, and this was my turning point. This was the first time I put my head down and actually scrutinized my financial numbers. And I realized, and I will be sharing them with you very shortly, I quickly realized that one well-chosen commercial property outperformed my entire residential portfolio. I did not realize this prior to this. So the numbers spoke for themselves. The commercial property gave me stronger yield, better capital growth, and it gave me cash flow. So I pivoted my strategy from that point on. So tonight, I'd like to discuss with you where my property portfolio is currently at, how I got here or my strategies. I really want to reinforce Siobhan's point on the power of time and the power of compounding. The graphs that you see in textbooks, you'll actually see in my own portfolio. I'd like to discuss the role of resi, or just touch on the role of resi versus commercial property, and touch on very quickly what I coined my freedom flywheel, and it's become a little bit of my Bible. So this is my timeline, and why I shared this is because from giving face-to-face conferences in the last 2 years, the audiences have told me that they found this timeline invaluable because it offers them clear insight into the time it takes to build wealth, and it also demonstrates that everything that I've accomplished is equally achievable for them. That's number one. Number two, I want to blow your mind by telling you that generating $1 million in passive income is achievable, because just look at my very right-hand column. By 2026, this is not predicted, this is actual value. My property portfolio alone, I'm not talking about any other assets tonight except for my property portfolio. By 2026, my income from property should be at $996,000 per annum. That's pretty impressive. So let's start from the top. At the age of 25, I finished uni. By 28, I got married, and that's when I purchased my first home, which was a shitty shack in Wentworthville that was flood zoned and 3 meters above the ground. We're going to go on to talk more about Wenty a little bit later. From that shitty shack alone, I learned about the power of capital growth in property, because it gave us, so I was married, it gave us the equity to purchase our first investment property in Kellerville. So by age 29, I had 2 properties. I took a break for 1 year because I had a child. The year after, we bought our 3rd property, which is now the home that I live in. Took another break for child 2, then purchased another property. So by the time I was divorced and assets were divided, we went from 4 to I now owned 2 properties. The home was mine, and one of the commercial properties in Narellan was mine. So by the time I was divorced at the age of 36, I had 2 properties that were valued combined at under $1.5 million. I went into a hiatus for 4 years where I just worked and did not have the mental or emotional capacity to do anything more than just work and go home to my children. So in those 4 years, that's all I did. I just survived. And I found myself by the age of 40 coming out of my slumber to discover that I had actually achieved my aim of totally offsetting my home. So I then went back into the normal Anna mode and thought, oh my God, I've gone through 4 years and have not purchased a thing, and property had gone up in value. So I purchased 4, and I'll show you how I did it. A year later, I purchased another 2. So now I'm up to property number 8. Then COVID hit, and like I told you, the epiphany hit, and I realised that one commercial superseded in cash flow. It gave me more cash flow than 5 resis combined. So I then went on to purchase more properties, mainly commercial. So by 2025, so as of today, I have 12 properties. They are worth $25 million combined, and the income that I receive from them equals $938,000. So just under $940,000 per annum. So of these 12 properties, 7 are residential, and this includes my home. I include my home because I include it as part of the investment pool with good reason. So 7 residential and 5 commercial. And the commercial, I own 2 retail commercial properties, 1 industrial, but that 1 industrial actually has 2 tenants, and then 2 properties that's considered mixed use, which means council will allow for it to be turned into an office space, a medical suite, or multi-level residential dwelling. In New South Wales, I have a combination of residential and commercial properties. And in interstate, I only invest at this stage in Brisbane and in Perth, so Queensland and WA. This is a graph showing the rent that I receive. So it's a little bit busy, but the green at the top is the combined rent for both resi and commercial. The bottom few lines are actually rent received from resi, and then the purple and the orange lines are the commercial properties. So my resi rent, which is gross, so this is gross because between the properties, they provide me between 50. I'm not sure what my assistant has done there, but let's just say she's written 5,800 to 7,900 per annum. That doesn't sound right. I think that must be per month. But it's gross because residential properties, you've got to pay a lot of the outgoings yourself as the landlord. But in commercial, when we quote $65,000 to $284,000 per annum, it's net, because whatever rent I receive is actually true rent because the outgoings are also paid for by the tenant. So this is rent, not inclusive of outgoings. This is my epiphany moment. Once again, the green is the total rent received. The blue is the rent received from residential property, my 7 residential. The orange is income received from commercial property. And when COVID hit in 2021, you can see that residential rent went up. So there's a big spike. Now, this 1 commercial property, so that's the orange line that I had, I give the tenants a pretty good deal. I started with high rent, but I kept it at the same level, flat level. Bad strategy, by the way, don't do it. I kept it at a flat level for 10 years. And even then, by 2021, when all the residential properties had appreciated and that commercial property did not appreciate in rent, it was still superseding all the resis combined. And so the uptick in the orange is because at that point I pivoted and concentrated on purchasing commercial only. And so you can see my cash flow just goes up as a steep curve. It's not even exponential, it's a steep upward curve, upward line. This is market value of my properties. You'll see the bottom, there's flatlining, and that's my apartments. There's been minimal growth up until very recently. There's been an uptick in the apartments that I have in Brisbane, and in Western Australia, but it's been flatlined for a very, very long time. There's been there has been growth in residential properties, but the majority of my growth and therefore net worth has been from the commercial properties. So how did I do it? I basically, hopefully, have impressed upon you that I don't come from money, that as a junior doctor and having married another doctor who was, at the same level as myself, even by the time of divorce, we were both quite junior, and I had just entered general practice training. So when we first purchased our first home together, we didn't even have enough money for a 10% deposit. So back in 2002, you had to have 10% deposit, even as a doctor, to not have to pay lender's mortgage insurance. And we couldn't scrape that together between the two of us in 1 to 2 years. So we paid lender's mortgage insurance. So I did the math and calculated that even by paying lender's mortgage insurance, the initial outlay was $24,700, which was still cheaper than waiting to be able to save up for the 10% deposit, which would require me to save $30,000. So that's how I got into the property game, by paying lender's mortgage insurance to reduce the deposit that I had to give. Luckily, these days, we can buy a residential property for 5% deposit, and sometimes no deposits required, especially if it's our own home. How do I go back? Secondly, how did I go from buying 4 properties in rapid succession, 4 years post-divorce? I debt recycled my home. I don't know if people understand what debt recycling means, but very quickly, let's say I had $500,000 sitting in my offset account. I then pulled on that money, so I pull on $100,000 as a deposit to purchase investment property 1. I put on the next $100,000 and put that as a deposit towards property number 2. And I continued to do that until I got my 4 properties. What I've effectively done is converted my home, which was a non-tax deductible property, into a tax deductible one. Other strategies that I utilized. Now, I didn't have a lot of money, so I targeted houses that were under $500,000. So another strategy that I used was land banking. I looked for properties with a lot of land that had upside potential. And in this case, with this particular property in Bellbird Park in Queensland, which is part of Ipswich Council in Queensland, it was almost an acre. So it's 3,600 square metres, an acre being 4,000 square metres. And it already had zoning in place for 16 townhouses. It had this really shitty shack on it. And right now, people are paying $550 a week. So I had rent coming in. I purchased it for $390,000, and it's got upside potential. Developers are eyeing it. They're eyeing the whole neighbourhood, actually, and I've received offers, but I'm not selling. These days, I don't buy resi anymore, but if I do, it's because it has a unique feature. It offers lifestyle, such as this waterfront property. No one wanted it, once again, because it was a shitty shack, but it's on a cliff top, water views, never to be built out, and I've got DA approval to build a duplex on there. So once that's done and it's a holiday let, I expect to receive decent income from that also. So they're just a few of the strategies that I've employed. Learn from my mistakes. Don't buy apartments. They flatline in terms of value for a very, very long time. They don't provide much cash flow either, and neither do they give you much capital growth. I've thought about selling them, but they make such a small proportion of my portfolio that right now it makes no difference whether I hold onto them or sell them, so I've just held onto them. Stick to land and house. Now, this rule applies for when you're buying your own commercial premises as well. Buying apartments is a bit like buying office space, and that's why office spaces haven't been doing very well. The value is in the land, and then followed by the building and the quality of the build, and then the quality of the lease or the tenant. Buying an apartment or an office space is pretty much you're sharing your land value with 50 or 100 other people, depending on the size of your building. There's just not much land value there. So stick to land and house, and if you're going to buy commercial properties, stick to freestanding commercial properties. I wanted to make mention about offset accounts. To me, I use it as a tool to save. That's how I save. I put all my money into the offset accounts, and it's also how I keep my cash liquid in property. People say, but property isn't liquid. When they say that, they're assuming two things. They're assuming that you're highly leveraged, or that you're really, you've borrowed 80 to 90% or more to purchase that property, and therefore to be able to get that money back, you have to sell it. Well, I keep my LVR at a modest level. I keep it quite low, and I keep it in an offset account. There's pros and cons to that, but it's liquid money. Now, it serves two advantages or two purposes for me. Number one, it's my buffer or my emergency fund. If I need money quickly, I can pull on it very, very quickly. It also turns me into a cash purchaser. I've had one or two instances where a good property has come on the market. It's been returned to the market because the previous potential purchaser couldn't get the funds from the bank in time, and I've stepped in as a cash purchaser, and I've snapped a good deal. Now, what happens there is I've paid for it in my own cash, but I am still applying for a loan from the bank. And when the loan from the bank kicks in, which often can take several weeks to a few months sometimes, depending on the complexity, well, then I park that money, into that property, and therefore the cash that I injected into it literally becomes part of the offset, and I've got my money back. Banks hate you doing it because they lose money rather than make money, but that's what I do. And then I just rinse and repeat. That's all I've got to say tonight. Where can you find me? I'm all over social media. I have a Facebook page called Doctors Helping Doctors Grow, and I am Anna, where we talk about money, mindset, investing. I'm also on LinkedIn. And if you want more educational videos on female health, you can find me on all channels, including Instagram and TikTok, but it's under Norella Medical and Skin. I've incorporated my email and my mobile number on there if anyone wanted to touch base with me directly. But yeah, so thank you for having me. But this is the Freedom Flywheel. One last point, I promise. This is what I do in all aspects of my investing and in business life. So step one, learn before you earn. So master the fundamentals. So I start by learning the fundamentals, and then I apply them gradually. I take small deliberate steps to ensure I understand and can effectively implement each principle. I don't wait until I know it inside out. As soon as I learn something, I implement it. And then step two, I then build a foundation on it, and I begin by saving. So you heard that initially I saved by paying down my home loan. Over time, this evolved into reducing my loan to value ratio to 50%. In business, I follow the same philosophy. I make sure that my practice remains a reserve of $100,000 in the account. This is after paying all bills and taxes. Now, until I've got at least that amount in my business account, I don't advance to the next stage. So this acts as an emergency fund and a financial buffer for that business. Once I've achieved the emergency fund or the buffer, once I've built that 6-month emergency fund, I move on to investing. Now, I've happened to choose property because Australia's lending and legislative framework strongly support property investment. I think that my results confirm this. My results confirm this approach. It has outperformed my shares, and I don't have any bonds in my portfolio. I do have Bitcoin in my portfolio, and as discussed with Siobhan earlier, it offers superior cash flow to Bitcoin. And then I just rinse and repeat this process for each new venture. And then as I grow in confidence and capability, I take on larger and more sophisticated investments or business opportunities. But I follow this flywheel through everything that I do. And that's it. Oh, what's in the future? I lied. This is my last slide. I'm creating a structured course for doctors. I'll be outlining the steps I took at each stage of my financial journey in saving, investing, and business startup and scaling. It's going to be online with videos and worksheets. I've been quoted around $60,000, but it's going to be my gift to you. I hope to keep that wheel of giving going, and that if you purchase the course when it is released, I will donate the course proceeds to charity. I'll probably put out an EOI on the Doctors Helping Doctors Grow page shortly. That's it. Thank you.
Thanks so much, Anna. I'll get you to stop sharing, and then if anyone wants to put their videos back on and put any hands up if they want to ask questions, I shall throw myself into the financial void and ask a few questions. So I have to say I feel I'm definitely one of those people that did not pay much attention to my financial decisions when I first started out in practice. And I guess, Siobhan, I just wanted to ask, because my fundamental thing, which I didn't do, so for everyone who's on here, is I didn't put money into super when I was starting out in practice. I was, we were saving up to buy a house. I was trying to get a deposit, setting up a new practice. And I basically put my money into my practice and into other things, and my super was not part of that. I'm trying to make up for it now. What is your advice to all the female surgeons on this webinar, and for anyone who's going to be watching this in the future? What should we be doing about our super?
It's a fundamental question. The first thing is talk to your accountant about the available cash, and if you like Anna, you know exactly what that is. Check what the available cash is and whether there is a tax advantage by contributing to super over and above the number that is already going to super from a mandated perspective. So you want to think about it like this. Is it going to the tax office or is it going to my super fund? And even if you say the balance is low or small, the message is that it allows a conversation with the accountant will help you to decide, do I send it to the tax office or do I put it to the super fund? And the number just quietly compounds over time. But a good quality accountant will be able to help you with this. And then the other conversation is about those lump sum payments that you might be able to make down the track when there's some cash available after children have been educated or after the business is up on its feet or what have you. But the first thing is, don't worry if it's $1,000. It's a conversation with your accountant to say, do I add more to super? What is the after-tax benefit for me to do that? Start there, Peggy, is how I do it, and see what comes of it.
Okay. My next question, and until anyone else puts their hand up to ask questions, I'm just going to keep asking questions as they kind of come to my head. And Anna, you know, I've spoken to you before about property and things, and certainly I've got a terrible apartment that's not doing much, and I've got a residential property that's not doing much. How do you decide what's a good commercial property? How do you, you know, if I was just to decide to start investing in a commercial property, which you made sound very good, how do I go about it? What do I do?
So please know that commercial property investing is a higher risk asset compared to residential investing, and the banks know this, and therefore that's why the lending criteria is slightly, well, not slightly, a whole lot different to residential lending. But basically, what am I looking for? I'm looking for, so a lot of people talk about the fact that commercial property only gives you cash flow and no capital growth. I'm going to argue with that and say that in my portfolio, I've managed to achieve both cash flow and capital growth. But that involves a couple of fundamentals. Number one, apart from commercial properties that I've targeted where I know that my business is going to be a tenant, yeah, then I'm looking at a property and I'm scrutinizing the lease. Yeah. So the quality of the tenant determines whether you're going to get an income from that property or not. So that's really important to scrutinize the lease quality and the tenant quality. And then you're looking at the property itself. Is it in a good location? Because you want to reduce the risk of it going empty, because it's expensive for a commercial property to be empty. So it has to be in a good location. If you can get those, at least those two things right, you're majority of the way there. Third thing that maybe we need to be aware of is commercial property. There are different types of commercial property. And a lot of people, when they think about commercial property, they automatically think of office space in the CBD, and then they tell you how horrible commercial property is in terms of returns and capital growth and how things are plummeting. And that is correct. Offices haven't been doing very well. They're akin to an apartment. There is no land valuing them in them. And then with the work from home initiative too, offices are becoming less and less attractive. So warehouses is what's very popular in the commercial game. They're low risk, low cost, low insurance, low premiums. Banks love them. They'll lend you more. So look for warehouses. Retail are a slightly higher risk. Notice that I've got 2 retail, but I've got a healthy risk appetite. The latest retail that I purchased that's all over social media is the Scarborough one. Now, that's blue chip. I'm right by the beach. I've got 4 tenants. The 2 of the tenants have been there for 20 years. The rent goes up by 4% per annum. It's a really, really strong lease in a quality location. So yeah, there are some of the fundamentals that one needs to look at, and one cannot group offices as being all commercial.
Okay, thank you. We've actually got a question from Linda, and then Christine's got a question in the chat. So Linda. And if you're talking, Linda, you're muted.
Sorry, yes, I did put the question in the chat thing as well, because my sister's an actuary. I've got a self-managed super fund partly because of commercial real estate, because you can invest in commercial real estate through a self-managed super fund, which was, as you said, a warehouse, but eventually that was sold. So I've had the self-managed super fund for over 20 years, but I'm now looking at rolling over some of my state government super into that. And my sister, who's an actuary, is very concerned because she says self-managed super funds do not have the regulatory support that the APRA regulated funds do. And that's where there's all this fuss about the ones that have been really going belly up recently. So I'm asking, do you think a well-managed self-managed super fund is as safe as an APRA regulated fund, or am I an idiot to put all my money into one?
You ask a very relevant question. I think the broad message is that the rules apply to all. Superannuation rules and ASIC and APRA require accountability, reporting, and audit. The challenge around self-managed super is that you've got your hand on the steering wheel and you can invest where you choose. So with that choice comes more risk, and it requires support and scrutiny. So like anything that you do in life, you will research, you will check the bona fides of the advisor that you're engaging, you will check their qualifications, you will talk to other clients, you'll seek proof. Where things have gone wrong for people is when they haven't understood the structure that they're investing in, who has control of it, and where the money actually sits. So self-managed super as a structure gives you autonomy, as you've seen, where it allows you to invest in commercial property. Some of you will have your practices within self-managed super, for example, and that allows you to contribute into super more through the business. So that's something to think about. But then to your question around the accountability and the structure, the message is that the rules are the same, but you have more choice. Therefore, with the choice means that those that seek advice and find the right appropriate accountant / financial advisor / investment will be fine. Those that use the vehicle to invest in things that they don't understand, that is where risk is heightened. And that's probably how I think about it.
Linda,
Okay. Yeah.
Are you happy? Do you want to ask a follow-on question?
No, I would say I'm a bit more complicated because I was a dual US citizen, and that has a whole bunch of other financial and tax implications, which gives all the accountants a heart attack. But
yes, Linda, I'm well familiar in this lane. And the message is that the accountant, if they're not well exercised in this area, find one who is, because it is they're not curing cancer. They should be able to handle this. And your sister's right to flag and exercise caution about what you do with your money, because it's hard earned. The message is just make sure you check the bona fides of those that you're engaging with. Have they got the credentials? Do they know what they're talking about? That'd be my
okay. All right. Well, I'll wait and see what you tell Christine.
Well, so Christine's got two questions. So she's got the first question for Anna, which is, how do you cope with the concern about risk of not having a tenant? Make sure you have an emergency fund. I'm assuming that's to cover the cost of the loans and things.
Christine, really good question, and that's the concern for a lot of people, and it's what stops them from entering the commercial property game. So what I do is, if I have done my due diligence and ensure that the tenant is a good one and the lease is a strong one, what does that mean? That means there's a long contract in place. It means that the income received and the yield received far exceeds all the repayments, i.e. it needs to cover my mortgage repayments, and it needs to cover all of my outgoings. Now, when you buy something like a warehouse, it also covers your property management fee and your insurance as well. In retail, I can't pass on my property management fee, but in warehouses or industrial, I can. So you can see that with the amount of cost that can be passed on to the tenant, you should be very comfortably positively geared. That's number one. If the lease is long enough, and if they're a strong tenant, therefore they should be able to fulfill the lease, I can share with you a cash flow calculator and a loan breakdown calculator where you'll see that, you know, if year one you're, say, positive by 15,000 and year two you're by 20,000, well, how many years will it be before that lease ends, and how much money, how much of a buffer have you created, and is that enough to create a 6-month buffer for you? And the answer is usually yes. It should be yes. The yield should be yes. If it's not yes within a short time frame, by the time they finish their lease, before they exercise the option, you probably shouldn't buy it. There's probably something wrong in the lease there. and you're holding on to too many costs. So I've helped an ophthalmologist in Sydney. I've reviewed the lease for one of his poor performing commercial properties, and where he went wrong was actually the quality of the lease, where a lot of the costs that legally he could have passed on to the tenant. It was a legacy lease that he purchased and therefore inherited as the owner, and didn't realise that a lot of the things on there should not have been borne by him. Now, had it been you and I, we wouldn't have purchased that property because that lease wasn't strong enough, but he did and paid the consequences for several years. So that's how you mitigate it, Christine.
And an interesting point there around seeking the right advice. Have the right team around you to say, I'm considering this property or this share portfolio. I need someone to vet these legal contracts. And the thing that I notice is that when you've got really good lawyer engaged, this is cost of transaction. It's really important that this information is vetted and checked before you do anything to understand what are those risks. Don't DIY is the message, isn't it?
Okay. Christine, the next question for you, Siobhan, is could you share your thoughts on how one should select a stockbroker or a financial advisor, please? And she has put in that she's a happy client of yours. So
thank you for saying. The key here is that you are engaging people that have got the right credentials. You want to see that they are registered on the financial advisor register. You want to see that they have done university degree financial education. With that, there's recent exams that require people to pass to be calling themselves financial advisor. So look for those that have that word after their name. If they don't, it means they haven't passed the exam or have the educational requirements to meet the service level. Check also things like how long have you been working? Now, we want to see in an advisor a few business cycles. We want to see when it's gone bad. I started in 1996, so there's been 3 significant stress points in markets that we've lived through to be able to say, well, we know what happened then, this is what we think we can do. So the main point in checking is, are they credentialed appropriately? Are they on the financial advisor register? And then how do they invest? Do they outsource the investment decision to fund managers, which adds layers of fees for you? Or do they know what they're talking about and have a rigorous team around them to be able to invest directly? So, for example, what Anna is flagging is direct investment in property. Anna, for example, is not going into a syndicate with a whole lot of other people and using an agent to say, trust me, it's going to be fine. The message is doing the homework, partnering with a group who are independent and have rigorous research to back them. Quantitative analysis is important. So within choosing an advisor, there's a whole lot of choice around what you can do. And it's understanding the specialty that the person you're engaging actually can provide you. They might be good at structuring, but they mightn't be good at investing. Or they might be really good in one particular area, but they outsource investments. So there's some questions that I would ask, and I've flagged on the last part of my slide some key things to think about. Happy for that to be circulated.
Thanks. Anna, you wanted to say something?
I just wanted to ask you too, Siobhan, on that point. This is me asking from the point of like being a listener and learning from you as well. After we vetted the financial advisor and broker, and we're confident that they are well credentialed, what are some of the things that we can look for or ask to ensure that they can effectively apply the theory in a positive manner, and it's not just theoretical knowledge that's being regurgitated to us.
Yes. I think you say show me. Show me. I want to see examples of success. I want to talk to other clients. Show me on the basis of my circumstances what the investments will look like and backtest how they would have performed if I'd invested this particular scenario now, say 5 or 10 years ago. Now, there's some reasons why they'll say that mightn't work or the conditions have changed. That's why this investment is appropriate now. But I think the best way is to say, show me. Here are my circumstances. How would you recommend that I invest? Show me what that looks like, and then I can make a decision about whether I want to engage you. And that's how we work, for example. You want to see, not sign, here's a fee, and we'll tell you what to do. In fact, a good advisor will give you the answer to the question prior and say, these are the sorts of styles of portfolios. This is how it's worked for us on the basis of the last, say, 5 or 10 years. And this is how we would handle your situation today. And we can mathematically check and backtest to see how this portfolio would have handled if we implemented it today, but you've held it for some years. So the message is show me. And that sorts out a quality advisor from one that just wants to pop you into a range of different managed funds or investments where they would benefit, for example. That's how I am.
Okay. All right. The questions are coming in now. Anna's asking from Anna, I'm going to assume, what extra things do you need to consider when buying property away from where you live? And how do you choose a property manager?
When I buy things interstate, Anna, I use a buyer's agent because I'm not there to view it myself, and I would rather pay the fees to a good buyer's agent to source it for me. And I can go through the steps and process if you like. But then how do I choose a property manager? Usually when you use a buyer's agent, they will make recommendations. So they'll make recommendations as to who they know in the area, who they think is good. You can use the existing property manager, or in my situation, I do a combination of both and I interview all of them.
Okay. And then Samantha has got a question for Siobhan. Can you talk about investing in a bond ladder and direct access to these to avoid ongoing asset-based fees?
This is an interesting question. I suppose if you think about the returns that you get in bonds, for example, bonds are your fixed income, low risk investments. That's in theory how they should be. The return that you're getting at the moment is cash rate, about 3.5%, 4%. So I think the challenge is to say asset-based fees need to be commensurate with the return. You don't want to be paying an asset fee that is taking 1% of your, let's say, 4%. You need to see that the fee is going to fees there because it needs maintenance and it needs advice and guidance. But you want to make sure that the fee is there within the asset class. What we're noticing at the moment is that in the international, in crypto, for example, or in international investment, your fee can be 1% in a managed fund, 1 to 1.25%. But then there's this performance fee that the fund managers will receive that's performance over a particular hurdle rate. And you want to know that that hurdle rate is high before the performance fee kicks in, rather than if, for example, in a bond fund, you don't want to see performance fee. You know that this is a low risk investment. You would expect a fee of 0.25%, 1%. That's starting to be a bit high. But the challenge is direct investment in Australia in bonds has been tricky because the minimum spend is been $250,000. Now, there's a range of initiatives that are coming at the moment to help that, and the hybrid note market has provided quite a significant benefit for investors recently, where you buy on market as a listed investment and you don't pay those ongoing fees. So that's been popular.
Okay. Siobhan, I've actually got this question that I've been wanting to ask you for a while. So Frais Capital, how much money do I need to have before I can give you a call and say, hey, Siobhan, can you invest some stuff for me? What's the minimum that you would like someone to have? Because remember what Anna's little survey did, that we had people who had anywhere from 5,000 to 100,000.
Yes, yes. The message is that I help people. I don't have a minimum. The broad message is that people come to us by referral, and the idea is that we have a conversation to start with to say, how can we be useful for you? And that might be initially to say, you don't need our services today, but you might need a decent accounting conversation. We might need to shake the scruff of the neck of the super fund, the industry super fund, to see how that's behaving. And perhaps our services today aren't relevant for you yet. But the message is, I do not have a minimum. I work with people. And the idea is, if we can be useful for you to make sure that your finances are working as hard as they possibly can, then that's success for us. And the first and foremost is, when you're dealing with a financial advisor, it's about trust. It's about whether we're going to be useful for you. But I don't have a minimum. I work with people.
Excellent. I'm just going to say, because it is almost 8:05, and so I don't want to keep people in longer than that. But if people, because I know that there might be a few questions, so if anyone wants to ask any more questions, you can either put your hand up or type in the chat box. Otherwise, I'm going to say thank you. First of all, thank you, Siobhan, for sponsoring these events, because obviously it takes a little bit of money to run a webinar, and Monique's online and all those things. So, we do a little bit of funding to keep that going. And then I just want to thank both of you for giving us a talk tonight. I've actually learned quite a few new things that I did not know. And the slides, for anyone who's on, this will be put onto YouTube, but also Anna and Siobhan have both said that if anyone wants their slides, they can have them. So you can just get in touch with Monique and she can forward them on to you. Again, thank you so much. And I know that both of you would be more than happy to speak to anyone personally and individually. So if anyone was too shy to ask any questions, I think it's really important as surgeons to think about the fact that, we do want to retire one day, and we do know lots of surgeons that have really been so busy working and so busy spending their money and so busy buying expensive cars and getting divorced numerous times and doing all those things, that they end up basically having not the retirement that that everyone thinks that they should be having. So I think it's really important for us to be thinking about the future, and as Anna says, to be able to do what we love while being sure that we're going to have financial freedom in the future. So thank you so much. Bridget, you put your camera on. Did you want to ask a question, or were you just saying hello?
Oh, no, I just wanted to thank the speakers, and we often have our cameras off because it's after work and we're getting dinner for kids and stuff. So I just wanted to say it's not a lack of engagement, and thank you very much for speaking. It was great. Thanks, Pecky.
Thank you, Bridget. So thank you, everybody, for joining us tonight for another Women in Surgery webinar. And I look forward to seeing you at the next one. So thank you, everybody, and good night.
Bye. Thank you.
Bye.